Welcome to The Explainer. We're all about breaking down the complex stories behind the numbers. And today, we are digging into a really dramatic one, the sudden stock plunge of Molina Healthcare. Okay, just imagine this for a second. You wake up, you check the market, and you see this number next to a stock you're watching, minus 16%. That is a huge drop. It's the kind of thing that just makes your stomach clench, right? And get this wasn't some slow-motion train wreck over a month. Nope, this happened in a single day, a single trading session. For Molina Healthcare, October 23rd became a day they'd probably rather forget. So, what in the world happened here? And maybe, more importantly, what happens next? Well, we're going to dive right into the technical analysis to try and decode the signals, understand the forces clashing here, and figure out what might be on the horizon for Molina. All right, before we get into the nitty-gritty of why it dropped, let's kind of start at the end. What's the big takeaway, the bottom line from all the analysis right now? And boom, right away you see this real conflict. It's like a tug of war. On one side, you've got the bad news, a strong bearish trend. That just means sellers are totally in charge, pushing that price down, down, down. Plus, it's super volatile, which is just another word for risky. But then, on the other side, you've got this glimmer of hope. Some key signals are basically screaming that the stock is oversold. It's like the market overreacted, and that could mean a bounce back is on the table. So, how did we even get to this point? This technical tug of war? Let's hit the rewind button and look at the timeline, because this is where the drama really unfolded back in October. So the month actually starts off pretty good. The stock's riding high, over $203, but then it starts to drift down. By October 22nd, it's at about $195. And then comes the big one, October 23rd, the day the floor just completely fell out. The stock absolutely craters, hitting a low of $161. It managed to find its feet a little bit the next day, but wow, what a drop. In this chart, this really tells the story of the panic. What you're looking at is trading volume, basically how many shares were flying back and forth. Just look at that spike on the 23rd. It's huge. It's a massive red flag that something extraordinary was happening. We're talking about 7.85 million shares traded. To put that in perspective, the day before, it was only 2.7 million. When you see a spike like that, it's often what analysts call capitulation. It's a fancy word, but it just means pure, unfiltered panic. It's the point where sellers just give up, throw in the towel, and say, "Get me out, I don't care at what price." Okay, so after a day like that, the big question is the bleeding over? Or is this just a pause before the next leg down? To try and answer that, analysts look at a whole dashboard of technical signals. So let's break down what those signals are saying. And if you're not a pro trader, don't worry. Just think of these indicators like the gauges on your car's dashboard. You've got your speedometer, right? That's kind of like the stock's momentum. Then you have the engine temperature gauge. That's a bit like an oversold signal. It's a warning that things are running way too hot, or in this case, way too cold. They're all just tools that help measure the market's mood. And this one sentence from the report just sums up the whole dilemma perfectly. Yeah, the main trend is bearish. It's pointing down. But a certain group of these tools, called oscillators, are flashing this oversold signal. It's that warning light again, saying, hey, the selling has been so crazy, so intense, that it might just be running out of steam. And you can really see that battle playing out right here in the data. You don't have to read every single line, just get the vibe. You see one indicator like momentum, and it's flashing strong bearish. No surprise there, it confirms the downtrend. But then you look at something like the RSI, the Relative Strength Index, and it's screaming oversold. It's like one part of the dashboard is saying we're going down fast, and another part is saying we're about to run out of gas. It's a total classic conflict. So with all this conflicting info, where could the stock possibly go from here? Well, the analysis actually lays out three possible paths. So you've got the bullish path, the bearish path, and the neutral path. And really, it all boils down to two magic numbers, a ceiling and a floor. The ceiling is at $166.31. If the price can punch through that, it's a great sign for the bulls. It might mean a rally is starting. But the floor is at $159.50. If the price breaks down through that, we could be in for another 5 to 10% drop. And of course, there's the third option. It could just get stuck in the middle, bouncing between those two levels for a while. Okay, let's distill all of this down. What's the so what? What's the main takeaway for anyone keeping an eye on this stock? Here's the bottom line. The main trend, it's bearish. Confirmed. It's also super volatile, which means it's risky. The whole story right now is this big fight between the powerful downward momentum and that little glimmer of hope from the oversold signals. And what happens next really depends on those two key price levels we talked about, that $16.66 ceiling and the $159 floor. Whichever one breaks first will probably tell us who's winning this fight. So for now, the overall sentiment is simple. Be very, very careful. And that leaves us with the ultimate question, really, the one that all this data points to. Is this stock a falling knife, something you'd be crazy to try and catch, or is it a coiled spring pushed down so hard that it's just ready to explode upwards? The technical signals are at war, and the answer to that question will depend on which side wins in the coming days.